Welcome to the Finance Game Special Edition. This is your host, Ferdinand Ruano, Jose Miguel Crespi. This is a new one for you guys. We have been doing this since 2018 in Puerto Rico. We started in the radio, WIAC 740 for Orlando and all the area. So by popular request and petition, we're doing this in English. So we're going to keep doing that for you guys. Jose Miguel, welcome.
It's a pleasure to be with our audience who requested basically, as Ferdinand mentioned, for us to do a podcast, our podcast in English for the states people that want to listen to it. So we typically do it in Spanish for our Latin people and our most of our clients in Puerto Rico who follow this podcast as well. But now we are expanding, and thank God we are bilingual, right? And we can do this. So um, the purpose of this episode today and to continue to do this is to inform, educate, give some updates on what we're seeing on the financial market, stock market. We always do one episode that it's more broad on the financial and economic situation here in the States, also in our country, Puerto Rico. And then we also follow with a episode more focused on real estate, residential real estate mostly, strategies, investment alternatives that we offer and we manage. And we give some information regarding how that specific market is it's working and moving. So, as mentioned, the first one is always markets, Ferdinand.
Yeah, we talk about traditional, non-traditional markets, alternatives. We talk about different things that you are not going to usually hear because we use a lot of financial engineering and architecture. We manufacture solutions sometimes. So we take that approach that we get out of the square to get back to the center.
Yeah.
So I hope that you like it. Anyway, we're going to the motions of our routine, which is basically
It's been an interesting couple of weeks, definitely in the markets. Main topic has been as usual for the year 2025, the Fed, the Federal Reserve Board. What are they gonna do in the next meeting in the 17th of September? Tariffs, wars, right? A lot of news going on, but not surprisingly, at this point, the markets continue to be resilient. The economy in the states continue to be resilient. This morning, actually, we received the August jobs employment data. Um, I think that not for the first time, but people are starting to notice, Ferdinand, that there is now we see a slowdown in jobs in the jobs report in
for
the
people that they didn't listen. That this is the first time for the people in English. But if you have the opportunity to do translation in our Spanish versions and you go to the episodes in January, February, and March, we were talking about deceleration for the third to the fourth quarter, and we were looking for a probability of one cut, or probably at the end of the year, and probably 2026 first quarter we're gonna have probably the cycle of lower interest rates. Now, what we are seeing is that deceleration that we talk about it, the impact of tariffs, expectations, consumer demand, disposable income, housing, it's taking effect.
the fact that we have had the rate so high for so long now as well.
Yes.
Everything it's kind of melting now, right? The inflation numbers for the last couple of readings, they have been not bad, as well as the jobs before the one this
Correct.
morning. Actually, we saw slowdowns, but not nothing significant. But this one was way shorter than expected.
Yeah.
So now people are starting to notice, and analysts are starting to say, "Hey, okay, now we are basically confirming that the Fed should move. Okay, we are confirming that the Fed should move in the next meeting. Okay, August was a month that the Federal Reserve didn't have a meeting because they do the Jackson Hole event and the meetings there, the summit. But they have their upcoming meeting 16th and 17th of September. And interesting, Ferdinand, the Fed funds futures, they had over 85% probability yesterday before today's news of 0.25% rate cut, a quarter point rate cut. And after today's meeting, after today's information, actually what was a 0% chance of a 50 basis point cut launch of the way up to 15% chance. Okay, so from 0 yesterday to a 15% probability of a bigger cut of a half a point.
What I saw this morning around 8:15 in Bloomberg was 98% chance of a cut of 25 basis points September, 58% in October, and 90% in December, which was odd. Okay. I haven't seen the numbers. Probably you look at them more closely after that. But I assume that they're in almost 100%. Look at what happened to the 2-year Treasury note. It just plummeted. The 10-year is around 409. At the beginning of this morning was 419. That's almost 10, 11 basis points. So the credit market is taking notice.
Yep.
Taking
But
notice.
looking into the equities market,
Goldilocks.
Yep, Goldilocks scenario. That's
Goldilocks.
something that it's been mentioned. The equities, the Standard and Poor's 500, it's been resilient. And I saw earlier this week an interview to Jeremy Siegel from Wharton, right?
Wharton, yeah.
And he mentioned we have a market that might behave independently to all this situation. And his argument is just based in earnings. Earnings has been fabulous. Earning expectation continue to grow. Forward outlooks have been healthy. Some here and there, but mainly it's been good news. So for that people that say that the market is overvalued, he basically replies and says go to earnings, and you're gonna see that it's not that overvalued. So it's an interesting point. I actually share some of that vision. In our portfolios, the earnings have been perfectly fine, as expected, or even better.
You are earning an alpha almost on 10 points for those that follow the markets. Usually, talk a little bit about portfolios, how your stress-free retirement portfolio has behaving, how much is your risk-adjusted return, how much the volatility compared to the markets. And basically we had a webinar last week for US and Puerto Rico talking about different alternative investments with defined outcomes.
Basically we continue to perform amazingly on the equity side this year. The portfolio, it closed yesterday almost at 27% year-to-date return. S&P 500 is around 11 by now, until yesterday is closed, and but we continue to perform basically in other asset classes as well, as Ferdinand mentioned. The endowment approach continue to be a great alternative right now, a great approach to investing. Real estate portfolios, they are starting to look more and more attractive now.
Value.
We're gonna dig in a little bit more on the next episode, so stay tuned. But real estate starts to look more attractive now. On the fixed income side, you can always keep cherry picking good alternatives that you might find. Some corporates, good rating, they are looking attractive. So we continue to blend a little bit, right, of different asset classes and doing that endowment approach. Private credit, a great asset class, performing really well now. It's been every day you listen more now to why should you invest in real estate and private credit, and we've been talking about that for years. Um,
Mm-hmm.
so yeah, overall, and going back to the equities, we see it continues to perform great. Um, but something to mention, Ferdinand, it's the seasonality on the stock market. So September tends to be a flat to negative month,
It's the
basically.
worst month of the year.
The worst month.
People think it's October, but in reality, it's September.
September.
Yeah. Yeah.
It's where sometimes markets decide to take a direction for the rest of the year. It's September, so they tend to see if they want to finish strong or not. Definitely, I think that independently of great earning reports that we have seen on the equities market, they are paying attention as well to what the Fed will do, and but we expect to have a little bit of volatility during this time of year, and probably making more sense of everything later in the year to close out as usual. But overall great performance.
I think that it's very important for the audience, for the finance game special edition, to know that I would like you to talk about risk mitigation and risk management. Which are the tools that usually you have been consistent? How you have been consistent in providing alpha in down markets, flat markets, up markets, especially with the big correction we have at the beginning of the year. The fact that we hedged some of the portfolios in the pandemic and we were able to ride it out. But you have an approach of mitigation and risk management. I would like you to talk about that.
Yeah. So basically, internally, we like to be proactive when it comes to equities portfolio. We like to manage them. We like to rebalance them when it's needed. We like to make adjustments depending on market scenario and economic scenarios. We do that. So it's more a proactive approach. It's not that of indexing or buy and hold that we see most often. Also, one of the most important risk mitigation strategies, as I mentioned, is the diversification. It's what weight we are allocating to those uncorrelated or non-correlated assets like real estate. And for years, I always like to give the example of 2022. 2022 was a year that it was pretty bad, pretty negative all across the board on traditional investments, traditional markets, and just implementing alternatives and giving a little bit more weight for that specific year into private credit, real estate, especially real estate that continue to perform in different market scenarios, gave us an edge. And it worked like a actual hedge because we were able to mitigate the negativity of the traditional markets with positive returns in other asset classes like real estate. So that's our philosophy, Ferdinand, when we go to managing everything. We also the scrutiny that we implement at selection of companies for the portfolios is really important. We combine technical analysis. We combine some of the risk metrics as well. So we try to always be on top of it. We have market leaders. So depending on the sectors of the market, we typically have one of the companies that is a leader on that space. So that's really important as well. And that's how we manage. We always, like to mention if someone would like to dig in a little bit more, feel free to contact us. We are more than happy to help our people. And if not, stay tuned and you will learn a little bit more throughout
as the program goes. We will educate and we talk about the main thing. We are in the good times in the market, but markets usually they will have some turns, and usually we will talk the next time how you can really not time the market but just anticipate and rebalance the portfolios. Even good times and now you're having good games, try to realize them, to rebalance it in some lower risk assets or lower risk stocks or lower risk portfolio. So we will talk a little bit about that. Probably we're going to talk about how you hedge using defined outcomes. That is something that we described in one of the webinars that we did. And if someone would like to have that webinar, we did it in English last week.
You have to combine tax mitigation strategies as well, depending on the type of client, type of account. So it's a whole world, and the idea of the podcast is to actually bring this in rice and beans, as we like to say.
Well, no more. The next time we will have for the finance game, the special edition, very specific topics. We're really looking forward to join us for the next chapter.
Thank you.